Have you ever, stopped to truly consider how your everyday experiences are shaped by these invisible forces?
Hmm.
You know, like how your favorite brand of coffee always hits just the right note of rich aroma, or why that new plant-based burger tastes surprisingly savory and satisfying?
Right, it's not random.
Exactly. These aren't accidents. They're the result of a colossal, often hidden industry that touches nearly every product you interact with, shaping your daily life in profound ways you might not even, well, realize. Okay, let's truly unpack this. Today, we're embarking on a deep dive into an industry that's everywhere, yet often unseen. The global flavors and fragrances, or F&F industry.
Yeah, F&F. It sounds simple, but it's anything but.
Totally. This isn't merely about making things smell good or taste better. It's a multi-billion-dollar sector that's surprisingly resilient, incredibly complex, and holds a fascinating position within the broader economy. We've got a comprehensive investment analysis here, packed with key metrics, in-depth company profiles, and the intricate market dynamics that drive this space.
A lot of good data to dig into.
For sure. Our mission for this deep dive is to cut through the noise, extract the most important nuggets of knowledge from this material, and give you a shortcut to truly understanding what makes this industry tick, who the major players are, and, what the future holds.
Like a guide to being well-informed on something that's, well, everywhere.
Exactly. Think of it as your guide to becoming genuinely well-informed about a sector that's both essential to our lives and remarkably intriguing. So whether you're gearing up for a big meeting, genuinely curious about the science behind your favorite product's unique scent, or just love a good aha moment that changes how you see the world, we're going to distill the data and get straight to what truly matters for you.
What's truly fascinating here right from the start is just how deeply embedded these elements are in our lives. The F&F industry isn't a luxury. It's a compelling, non-cyclical sector with what financial analysts describe as defensive growth characteristics.
Okay, defensive growth. What does that actually mean for, the average person listening?
Well, what that means for you is that it tends to perform steadily, consistently delivering growth, even when the broader economy experiences significant slowdowns or even recessions.
Wow, okay.
Think about that for a moment. In a world constantly buffeted by economic winds, the F&F industry stands as a surprising beacon of stability, almost an anti-recessionary play. It's the hidden, fundamental layer supporting daily consumption, making it a truly unique sector that offers a degree of insulation from typical market volatility.
That's a powerful point about their non-discretionary nature. I mean, people always need to eat, right?
Wow.
And clean. Does this consistent demand also grant these companies a certain degree of pricing power given how essential their products are?
Oh, absolutely.
Because the F&F industry truly plays an integral, though often invisible, role in the global consumer staples value chain. We're talking about the core components in virtually everything you buy. The essential taste in your processed foods and beverages.
The fresh scent in your shampoo and soap that makes you feel clean.
And the clean aroma in your household cleaners and detergents. This sheer ubiquity, as you said, provides a resilient demand profile because people will always need to eat, clean, and practice hygiene regardless of economic conditions.
Precisely.
Yeah.
It's what creates that stable and predictable revenue base for the companies operating within this space.
So that deep embedding ensures that predictable demand stream.
And yes, it absolutely underpins their pricing power. When a flavor or fragrance is fundamental to a product's identity, its very reason for being purchased, companies have a strong position to pass on costs.
Right. If you change the taste of Coke, it's not Coke anymore.
Exactly. This combination of consistent demand and pricing power is a rare and highly attractive quality in any market, providing these companies with a strong foundation for steady performance over time, and indeed a notable degree of insulation from the ups and downs of the broader economic cycle.
And it's not just stable, it's also expanding at a healthy clip. Looking at the numbers, the global F&F market was valued at approximately, USD 29.1 billion in 2022.
Oh, a sizable market already.
But here's the kicker. It's projected to expand at a robust compound annual growth rate, or CGR, of 5.4% to reach a significant USD 44.5 billion by 2030.
That's solid, consistent growth.
It is. That's a picture of robust, consistent expansion, showing that while it's defensive, it's certainly not stagnant. It's a dynamic sector that keeps finding new avenues for growth.
Indeed. This impressive growth is driven by what we call powerful, long-term secular trends.
Okay, secular trends. Like a river current, maybe, not just short-term waves.
That's a perfect analogy. Think
Yeah.
of them not as short-term waves that come and go with economic cycles,
Yeah.
but more like a steady, deep river current that consistently pulls the industry forward, irrespective of immediate market conditions.
Got it.
And one of the most impactful of these drivers is the rising disposable incomes in emerging markets, particularly in regions like Asia-Pacific and Latin America.
Right. More people with more money to spend.
Exactly. As hundreds of millions more people in these areas climb into the middle class, their consumption habits naturally evolve. They gravitate towards more processed and packaged foods, convenience meals, and a wider range of personal and household consumer goods that rely heavily on flavors and fragrances.
So that shift directly boosts demand.
It does. This structural shift is directly supercharging and expanding the market for F&F ingredients.
And Asia Pacific is absolutely leading the charge there, isn't it?
Oh, significantly.
Our sources show it as the largest market by far, accounting for a massive 31.68% of the industry's 2024 revenue. Not only that, but it's also projected to be the fastest growing region, with a projected CAGR of 5.61% through 2030.
That's where a huge chunk of the future growth lies.
So while developed markets remain important, the real long-term fuel for this industry is clearly coming from these rapidly developing economies and their burgeoning consumer bases.
Precisely. On the other side of the coin, in mature markets like North America and Europe, we're seeing a different, yet equally powerful, consumer-led shift.
Ah, the health and wellness trend.
That's the one. This is the massive and sustained trend toward health, wellness, and natural or clean label products. Consumers are increasingly scrutinizing what goes into their food, beverages, and personal care items, demanding transparency in ingredients they perceive as healthier, more sustainable, or simply cleaner.
Yeah, you see natural on everything now.
You do. And this trend, too, is a significant driver for F&F companies, pushing demand for specific, often premium solutions that meet these evolving preferences, from natural sweeteners to allergen-free flavors and plant-derived fragrances.
And it's worth noting that within this overall market, the flavors segment actually constitutes the larger portion, coming in at 56.19% of the market in 2024.
Taste is king, it seems.
Apparently. And it's even forecast to grow slightly faster than fragrances at a 5.65% EGR. So while both taste and scent are vital and, intertwined, the ability to make things taste good consistently and innovatively holds a dominant share of this multi-billion-dollar business. Now let's talk about the structure of this industry, because this is where it gets really interesting and, frankly, quite unique.
It is quite concentrated.
You might not have heard of them, but the global F&F market is what's known as an oligopoly. Expert, for listeners who might not be economists, can you maybe paint a picture of what that really feels like? Is it like trying to set up a new phone company when only four giants own all the cell towers and patents?
That's a fantastic analogy. Yes, it's very much like that. An oligopoly means it's an industry highly concentrated among a very small number of dominant players. Givaudan, International Flavors and Fragrances, or IFF, Diaz and Firmenich, and Symrise.
Just four main players?
Those four companies collectively control a substantial majority of the global market. And the reason for this concentration isn't by accident. It's a direct reflection of the formidable and durable barriers to entry that make it incredibly difficult, almost impossible, for new players to break into this market.
Okay, so these barriers, they're what keep the competition out and the profits in.
Essentially, yes. These barriers create what we call significant and durable pricing power for these incumbent leaders, allowing them to maintain strong margins and consistent profitability over time.
So why is it so incredibly hard to get in? What are these seemingly impenetrable walls?
Well, several things stack up.
For starters, there's the immense scale and global reach these giants possess. They benefit from massive economies of scale in manufacturing, in the procurement of often rare or specialized raw materials, and in their global distribution networks.
All right, they can buy cheaper and deliver anywhere.
Exactly. Their expansive global footprint allows them to serve multinational consumer packaged goods, or CPG, clients seamlessly across all major markets, something a small startup simply can't replicate. Imagine a global food brand needing a consistent flavor profile for a product launched in 50 countries.
Only the big guys can handle that reliably.
Precisely. Only these large players have that kind of logistical and production muscle.
And beyond sheer scale, there's the intellectual property, which is perhaps the deepest moat of all. This industry is incredibly knowledge-intensive, a true blend of art and science.
So R&D is key.
Absolutely critical. The leading firms invest heavily in R&D, typically 7–10% of their sales, which for a multi-billion-dollar company is an enormous sum to build vast libraries of proprietary flavor and fragrance compounds, patented molecules, and innovative technologies.
Wow, 7–10% is huge.
It is. And this intellectual property, built over decades, sometimes centuries, of scientific research and patented discoveries, is nearly impossible for new entrants to replicate. It's not just about creating a new scent. It's about the deep scientific understanding of how aroma molecules interact, how flavors are perceived, and how to stabilize these compounds in various applications. It's a closely guarded secret sauce, built over generations.
Okay, so scale, massive R&D. What else? And then there's the deep customer integration and the high switching costs. F&F suppliers aren't just selling ingredients. They're deeply integrated partners in their customers' product development processes, often co-creating products from the ground up.
They're embedded in the client's process.
Totally. A specific flavor or fragrance is frequently a core part of a consumer product's identity and brand equity. Think about your favorite soda or that unique scent of your preferred hand soap. That specific taste or smell is absolutely critical to its brand, its memory, its very essence.
You mess with that, you mess with the brand.
Exactly. Changing an ingredient like that isn't simple. It requires extensive reformulation, expensive and time-consuming consumer testing to ensure acceptance, and navigating complex regulatory approvals. All of this creates significant switching costs for their customers.
Which leads to incredibly long-term, sticky customer relationships for the F&F companies. It's a true partnership, not just a transaction. They're locked in a way.
Yeah, sticky is a good word for it. And there's one more big one, right? The regulations.
Lastly, and this is a significant hurdle, is the extensive regulatory expertise required. The industry operates within a stringent and complex global regulatory framework governing everything from food safety and chemical usage to labeling requirements across different jurisdictions.
It's a legal minefield, basically.
It can be. Navigating these regulations requires substantial in-house expertise, legal resources, and often years of experience. For example, the International Fragrance Association's, or IFRA's, 51st Amendment, which was introduced in 2023, brought in 48 new ingredient restrictions.
48, wow.
Yeah. This kind of widespread change necessitates extensive reformulation and supply chain adjustments across the industry, a hurdle that disproportionately favors established players with dedicated regulatory departments who can absorb that kind of burden and guide their clients through the labyrinth of compliance.
So smaller players just can't keep up with that kind of regulatory churn.
It's incredibly difficult and costly.
Yeah.
This very structure means that competition among the big players is primarily based on innovation, quality, service, and regulatory assurance rather than on price alone, which further enhances the stability and profitability of the incumbents.
Makes sense. It's a quality game, not just a price war. Now, despite these incredibly strong underlying fundamentals, the period between 2022 and 2024 hasn't been without its significant challenges.
No, definitely some headwinds.
The industry has faced substantial headwinds, including unprecedented raw material cost inflation,
Huge spikes there.
persistent global supply chain disruptions that made sourcing incredibly difficult,
Getting things from A to B was a nightmare for everyone.
and geopolitical tensions that affected both sourcing and logistics. It's been a tough couple of years, truly testing the mettle of these giants, but ultimately highlighting their remarkable resilience in navigating such storms.
And that period was also defined and reshaped by transformative merger and acquisition activity. Really big deals happened.
Right, like the DSM and Firmenich merger.
Exactly. Most notably, we saw the merger of Royal DSM and Firmenich, which created the new industry powerhouse DSM Firmenich. And then there's the ongoing complex integration of DuPont's Nutrition and Biosciences, or N&B, Division by International Flavors and Fragrances, or IFF.
That IFF deal sounds particularly complex.
It is. These massive deals, while aiming for synergistic benefits, have introduced significant execution risk and balance sheet pressure for the involved parties. They're like trying to merge two supertankers in choppy waters. It's a delicate and complex operation that requires immense focus and can divert resources from other areas, creating a fascinating and sometimes unpredictable dynamic within the industry as they work to digest these large acquisitions.
Okay, so a stable industry, but facing some recent turbulence and major shifts. Moving beyond the structure, let's talk about the very essence of what these companies create, the ingredients themselves, and how innovation is shaping them.
This is where the consumer trends really come into play.
And the single most significant driver reshaping this entire industry, hands down, is the dominant and accelerating shift towards natural ingredients.
Absolutely. It's massive.
This isn't just a niche, it's the core of what's happening, fundamentally altering product development across the board.
It's an undeniable and powerful movement, fueled by persistent, global consumer demand for natural, organic, and clean label products. People want to understand what's in their food, drinks, and personal care items, and they're willing to pay a premium for ingredients they perceive as healthier, more sustainable, and less artificial.
And the numbers back that up, right?
They do. This is why the global natural F&F market is growing at a premium to the overall market, with a projected compound annual growth rate of 6.3%. What's truly remarkable is the sheer scale of this shift. Natural ingredients constituted approximately 74.25% of the total market revenue in 2022.
74%, that's staggering. Nearly three-quarters of the market revenue is from naturals.
It is. This is not a marginal trend, a passing fad. It is a fundamental transformation that is reshaping every aspect of the industry.
And it puts immense pressure on consumer packaged goods companies to reformulate their products with these natural and plant-based solutions, which in turn creates a substantial tailwind for F&F suppliers who are agile enough to provide these sought-after ingredients.
Think about how many new natural or plant-based versions of familiar products you see on grocery store shelves now. That's this trend in action.
Exactly. And within the natural category, essential oils derived from plants are a dominant product category, accounting for over 74% of that revenue in 2021. So this isn't just a consumer desire, it's a massive commercial reality driving billions in revenue.
This, however, raises an important question. Or maybe a paradox.
A paradox. How so?
While this trend is a powerful growth engine, it simultaneously introduces significant operational and financial complexity for these companies. That's what we call the natural premium paradox.
Okay, so naturals are good for sales, but hard to manage.
Precisely. Natural raw materials are subject to far greater price and supply volatility. Think about it. Their availability and cost depend entirely on agricultural yields, unpredictable climate conditions like droughts or floods, and even the geopolitical stability of their sourcing regions.
Right. A bad vanilla harvest in Madagascar suddenly makes everything expensive.
Exactly. A bad harvest in one part of the world or a sudden political instability in a key growing region can directly pressure gross margins and create massive headaches for supply chain management for these companies. It's a constant tightrope walk.
So the ability to actually deliver these naturals reliably becomes a competitive advantage.
Absolutely. The ability to profitably and reliably supply natural ingredients at scale has thus become a key competitive differentiator. Companies that have secured their supply chains through vertical integration, meaning they control more of the production process, sometimes from the actual farm all the way to the finished ingredient.
Like owning the farm.
Sometimes, yes, or having very strong partnerships. Or through long-term grower contracts or even advanced sourcing technologies like precision agriculture, are much better positioned to navigate this challenge.
Interesting.
This trend is not merely a sales tailwind. It's a fundamental test of operational excellence that is likely to widen the performance gap between the industry leaders and their smaller rivals. Those who can manage this volatility effectively will truly stand out.
So while everyone wants naturals, it's a high-stakes game to deliver them consistently and profitably. But it's also crucial to understand that despite this powerful, undeniable trend toward naturals, synthetic ingredients remain absolutely foundational to the industry and will continue to be.
Oh, for sure. Synthetics aren't going away.
They accounted for over 66% of the flavors market in 2024 and nearly 70% of the overall F&F market. So still the majority by volume and value.
And for very good reason. Synthetics offer significant advantages in cost-effectiveness, stability, and scalability that naturals often cannot match.
Especially for huge mass-market products.
Exactly. For mass-market consumer goods, where cost and use is paramount, synthetics are often the only viable option to ensure affordability and consistency across billions of units. Think about a standard soft drink or a universal cleaning product. Ensuring a consistent taste or scent in such massive volumes often requires the precision, purity, and reliability that synthetics can provide.
Not to mention that certain unique scent profiles or highly specific functional ingredients simply cannot be sustainably sourced or replicated from natural origins at an industrial scale. Some things just have to be made in a lab.
Correct. This reality necessitates a very sophisticated dual-pronged strategy for the major players. They need to maintain a cutting-edge, high-margin naturals portfolio for those premium applications where consumers are willing to pay more.
while simultaneously operating a highly efficient, scaled synthetics business for the mass market.
Right. This highlights the truly comprehensive capabilities required for market leadership in this space. It's not an either, but a mastery of both worlds. You need the art and the science, the natural and the synthetic.
And it's not just the ingredients, it's how they're delivered, right? Technology
Yeah.
plays a huge role.
Exactly. It's about having the breadth of scientific and technical expertise to deliver both. And beyond just the ingredients themselves, technological innovation is a massive differentiator that separates the leaders.
Yeah.
We're not just talking about chemistry here.
Like encapsulation.
We're seeing incredible advancements in encapsulation and delivery systems, which are crucial for product performance. This allows for things like time-release fragrances in laundry detergents, so your clothes smell fresh long after they've come out of the wash.
I always wondered how they did that.
Or flavor protection during food processing, ensuring that delicate tastes hold up through cooking, freezing, and reheating cycles. It's quite sophisticated.
And it goes even further, becoming truly cutting edge. Here's where it gets really interesting, expert. You mentioned AI designing snack flavors earlier. That sounds like something straight out of a sci-fi movie. Can you give us a glimpse into how that actually works and what the implications are for consumers like us?
It's definitely cutting edge, but it's no longer sci-fi, it's happening right now. Leading producers are increasingly harnessing artificial intelligence and vast data sets, think millions of data points, to identify regional taste preferences, analyze consumer trends online, and then accelerate the creation of customized flavor profiles.
So the AI looks at what people like in, say, Brazil versus Japan.
Exactly. Imagine feeding an AI millions of data points on consumer preferences from different cultures, combined with chemical structures of successful flavors, maybe even sensory panel data. The AI can then predict novel combinations that are likely to appeal, drastically cutting down on the traditional, sometimes lengthy, trial and error that perfumers and flavorists undertook.
That's incredible. So faster innovation, more targeted products.
Precisely. This isn't just about making things taste good faster. It's about using cutting-edge tech to tailor products to hyper-specific markets and evolving consumer desires, which significantly enhances their value proposition to customers, allowing them to bring new, highly targeted products to market much faster than before.
That's absolutely mind-blowing. Imagine the implications for product development and marketing. So with all this innovation and complexity, what does this all mean for the big players in this space? We've got four titans we really need to look at, starting with the undisputed leader, Givaudan.
Right. Givaudan SA, trading as Given SW on the Swiss Stock Exchange, is without question the global leader in the F&F industry. They're sort of the benchmark.
And they're split into two main parts.
Correct. It operates through two remarkably well-balanced divisions. Taste and Well-Being, which covers flavors for food and beverages and broader food ingredients, and Fragrance and Beauty, focusing on a wide array of fragrances and active beauty ingredients. This balanced diversification across both taste and scent provides Givaudan with an inherently stable and consistent revenue base.
And they've got a strategically diversified geographic footprint that contributes to that stability. In 2022, 37% of their sales came from Europe, Africa, and the Middle East, 26% from North America, 25% from Asia Pacific, and 12% from Latin America.
Really balanced globally.
It is. This gives them a remarkably balanced exposure to both high-growth emerging markets, which account for 54% of their sales, and mature markets at 46%. It's a masterful blend of stability from established regions and significant growth potential from rapidly developing economies.
And they have a particular strength in high-end perfumes, too.
They also hold a particularly strong market-leading position in the high-margin fine fragrances category, serving the world's most prestigious luxury and designer perfume brands, which adds a significant premium feel and margin to their portfolio.
Givaudan's primary competitive advantage, the bedrock of its leadership, lies in its unwavering, almost obsessive commitment to innovation. We talked about R&D spending earlier.
And they spend the most.
They boast the industry's highest R&D investment as a percentage of sales, allocating a colossal CHF $522 million, or 7.3% of their sales, to research and development in 2022.
That is a lot of money for R&D.
It is. This enormous investment fuels a powerful innovation engine, protected by a vast portfolio of over 4,000 active patents. These aren't just patents for isolated molecules. They cover entire processes, novel delivery systems, and unique combinations, making it incredibly difficult for competitors to replicate their offerings or even catch up to their pace of discovery. It's a true intellectual moat around their business.
And their approach to innovation isn't just about lab work, it's about deep collaboration. They have a truly collaborative co-creation process with their customers, leveraging 65 creation and application centers worldwide.
So they work with the CPG companies directly.
Hand in hand. These centers aren't just sales offices. They're hubs where Givaudan's experts work side by side with CPG companies to develop bespoke, value-added solutions tailored to specific product needs and consumer preferences. This deep integration makes Givaudan an indispensable partner, not just a supplier.
Creating those exceptionally high switching costs we talked about earlier.
Exactly. It's like having their R&D department embedded within your own. And if that wasn't enough, they even operate their own perfumery and flavorist schools in Paris and Grasse, ensuring a continuous pipeline of world-class creative talent, a true long-term play on human capital.
That's quite something, building their own talent pool. Financially, Givaudan has a phenomenal long track record of consistent and profitable growth that few companies can match.
What do the recent numbers look like?
For the full year 2023, they reported sales of CHF 6.9 billion, representing robust like-for-like growth of 4.1%. They've consistently demonstrated strong pricing power, successfully passing on higher input costs to customers without significant disruption, which is a testament to their critical role.
And profitability.
Equally robust, with a 2023 EBITDA margin of 21.3%, which expanded to an even more impressive 23.8% in 2024 on sales of CHF 7.4 billion. They're also an exceptional cash flow generator, achieving a record free cash flow of CHF 920 million in 2023, representing an impressive 13.3% of sales.
Wow, strong cash flow. And dividends.
Very consistent. This allows them to consistently increase dividends since their 2000 IPO at CHF 68.00 per share for 2023 and CHF 70.0 for 2024, further underlining their financial strength and commitment to shareholders.
During the recent inflationary period of 2022-2023, Givaudan really shined, showing superior operational execution and pricing power compared to many peers. They efficiently passed on rising raw material and energy costs to customers without experiencing significant volume declines, a rare feat in such an environment.
They navigated that storm very well.
They did. Their 2025 strategy, aptly named Committed to Growth with Purpose, is firmly on track with ambitious financial targets of 4-5% average like-for-like sales growth and over 12% free cash flow as a percentage of sales. They're really a picture of stability, excellence, and forward-looking strategy.
This consistent strong performance and undeniable quality are fully reflected in their valuation, though. Givaudan consistently trades at a significant premium to its industry peers.
What kind of premium are we talking?
A trailing 12-month PE ratio, around 36x, in mid-2024. This premium is well above historical averages and competitors, but it's largely justified by their best-in-class profitability, highly predictable cash flow generation, and a disciplined capital allocation strategy that has created substantial long-term shareholder value.
So you pay for quality. What's the risk then?
Well, the primary risk, therefore, for potential investors lies in this premium valuation. It leaves very little room for operational missteps, unforeseen market shifts, or a slowdown in their growth trajectory. Any perceived wobble in growth or margin compression could trigger a significant re-rating of the stock.
High expectations priced in.
Exactly. Furthermore, as the undisputed market leader, maintaining that competitive edge and finding new avenues for outsized growth can become incrementally challenging, like trying to grow a giant tree even taller.
So if Givaudan is the undisputed premium leader, then International Flavors and Fragrances, or IFF, is what you might call the quintessential turnaround story.
That's a good way to put it. A very different situation.
Following its transformative and indeed massive merger with DuPont's Nutrition and Biosciences, N&B division, in 2021, IFF technically became the industry's largest company by revenue, but it also took on a significant challenge.
A huge integration challenge. That's a key point. IFF now operates across 4 distinct segments. Nourish, which encompasses food ingredients, flavors, and savory solutions. Health and Biosciences, focuses on highly specialized areas like probiotics, cultures, enzymes, and home and personal care ingredients.
So much broader than just F&F.
Much broader. Then Scent, covering fragrance compounds and ingredients, and Pharma Solutions, dealing with pharmaceutical excipients. This structure gives IFF an unparalleled product breadth, standing from traditional F&F to highly specialized, science-backed functional ingredients that touch multiple aspects of consumer health and wellness.
Their primary competitive advantage, therefore, is truly their unmatched scale and the sheer breadth of their product portfolio. The N&B merger, despite its challenges, gave them world-leading positions in high-value specialty ingredients like probiotics, cultures, and enzymes, areas where their traditional F&F peers have less presence.
Right. Areas Givaudan isn't as strong in.
Exactly.
Yeah.
This allows IFF to offer integrated solutions to customers that combine taste, texture, health, and preservation. Imagine a client needing to develop a new yogurt that tastes great, has the right mouthfeel, and includes beneficial probiotics for gut health. IFF can provide that holistic solution, which is a unique and compelling value proposition in the market.
However, the period following the N&B merger has been notably challenging, marking a significant deviation from the company's historical performance.
How so? Bigger isn't always better.
Well, while it did significantly increase IFF's revenue base to $11.48 billion in 2024, top-line growth has been stagnant, failing to live up to initial expectations. Profitability, more critically, has been severely impacted by integration costs, a complex organizational restructuring, and particularly by significant goodwill impairment charges.
Goodwill impairment.
That sounds bad.
It's not great. These charges led to substantial GAAP net losses of $2.57 billion in 2023 and $835 million in the trailing 12 months ending Q1 2025.
Expert, for our listeners who might not be deep into corporate finance, what exactly does a goodwill impairment charge like that really signal about the health of a huge acquisition like N&B? It sounds like a big number that has major implications.
Great question. In simple terms, when a company like IFF buys another company, they often pay more than the fair market value of its tangible assets, things like factories and equipment. That extra amount is called goodwill, and it represents the value of intangible assets like brand reputation, customer relationships, or specialized technology.
Okay, the intangible value. Right. A goodwill impairment charge means they're admitting that the value of those intangible assets they thought they acquired has significantly decreased, or that the acquired business isn't generating the expected earnings. It's essentially a non-cash write-down where they acknowledge that the initial valuation and synergy assumptions of the merger were, well, overly optimistic.
So they basically overpaid, or the business isn't performing as expected.
That's the essence of it. It doesn't mean cash is leaving the bank today, but it signals a significant reassessment of the acquisition's long-term value and profitability.
That puts it into clear perspective. It means they bought a house expecting it to be a gold mine, only to realize later it needs far more work or isn't worth as much as they budgeted for.
Good analogy.
And on top of that, their balance sheet is heavily leveraged, with net debt to credit-adjusted EBITDA standing at a high 3.8x at the end of 2024, which is a key concern for investors, signaling significant debt burden.
Debt is definitely a focus for them now.
In response to these headwinds, IFF has initiated a significant portfolio optimization program to divest non-core assets, with the planned divestiture of their pharma solutions business being a crucial step to reduce debt.
Selling off pieces to get leaner and pay down debt.
Exactly. They've also seen significant management changes, including a new CEO, J. Eric Fierwald, appointed in early 2024, who was squarely tasked with steering this incredibly complex turnaround.
A tough job for the new CEO. Reflecting these substantial challenges and the uncertainty, IFF currently trades at a steep discount to its high-quality peers.
How steep?
Its trailing 12-month PE ratio is negative due to those significant GAAP losses, and its other valuation multiples are substantially lower than those of Givaudan and Symrise. The market valuation clearly incorporates a high degree of execution risk and uncertainty regarding the timing and ultimate success of the company's turnaround strategy and deleveraging efforts.
So the market is saying, show me the money.
Pretty much. If we connect this to the bigger picture, IFF represents a classic value and turnaround investment case. The critical question for you as a learner here and for any potential investor is, do you believe in management's ability to execute this incredibly complex plan and unlock the latent value? It's a big if.
A definite show-me story. All right, next up is DSM Firmenich AG, trading as DSFIRES, which we can think of as the new powerhouse on the block.
Another product of a mega merger.
Right. This company was formed just recently in May 2023 through the groundbreaking merger of Dutch nutrition and materials science giant Royal DSM and the venerable Swiss private F&F house Firmenich. This union immediately created a new industry giant with a truly unique set of capabilities.
This combination has indeed created a distinct profile within the industry, brilliantly blending Firmenich's centuries-old creative expertise in flavors and perfumery with DSM's deep scientific and biotech capabilities in vitamins, enzymes, and nutritional ingredients.
So creativity meets science.
In a big way. The company is structured into 4 business units: perfumery beauty, taste, texture and health, health, nutrition and care, and animal nutrition and health.
Animal nutrition, that seems different.
It is, and as part of its broader strategic repositioning post-merger, DSM-Firmenich is also in the process of separating and divesting its animal nutrition and health business to focus more intensely on the higher-margin, consumer-facing segments that leverage its core F&F and health expertise.
Ah, so they're focusing up. What's their main advantage then?
Their core competitive advantage really is their uniquely comprehensive and science-backed portfolio. They're currently the only major player that combines top-tier capabilities in perfumery and taste with such a deep scientific foundation in health and nutrition.
So they can do it all. Taste, smell, health benefits.
That's the idea. This allows them to offer truly integrated solutions that address multiple evolving consumer trends simultaneously. Imagine a client needing to develop a new plant-based beverage that not only tastes delicious, but is also fortified with specific vitamins, minerals, and probiotics for health benefits and offers a clean, appealing label. DSM-Firmenich is uniquely positioned to deliver that kind of holistic health, nutrition, and beauty positioning, setting them apart from competitors who might specialize in only one of those areas.
That sounds powerful. How are they doing financially, given they're so new?
Financially, as a newly merged entity, their track record is, by definition, short. However, for the first half of 2025, they reported strong group sales of $6.5 billion, reflecting robust 7% organic growth.
7% organic growth is solid.
It is. Critically, their adjusted EBITDA also saw a significant boost to $1.26 billion, and their adjusted EBITDA margin improved remarkably to 19.4% from 15.5% in the prior year period.
That's a big jump in margin. Synergies kicking in? Seems like it. This improvement was largely driven by good organic growth, combined with the initial realization of those anticipated merger synergies. The company has stated it's firmly on track to achieve its ambitious target of approximately $350 million in total. Adjusted EBITDA from synergies, signaling that the integration is progressing as planned.
And their recent history is truly defined by this massive merger and the subsequent integration and portfolio reshaping. A key strategic priority, as you mentioned, is the separation and eventual exit of the animal nutrition and health segment, which will transform them into an even more focused, pure-play, consumer-focused entity.
Getting rid of the less related parts.
Right. They even completed the sale of their feed enzymes business for $1.5 billion in June 2025, which is a significant step towards that goal. They're also actively returning capital to shareholders, having initiated a $1 billion share buyback program in April 2025, signaling confidence in their future cash flow generation.
The market is still establishing a clear valuation framework for this combined entity, given its recent formation, with a PE ratio currently around 21-24x. So cheaper than Givaudan, but maybe not as cheap as IFF seems.
Somewhere in between, yeah. Some of the parts analysis is often used by analysts, given their diverse segments, trying to value each business unit independently. Their valuation will be highly sensitive to their ability to deliver on synergy targets and successfully execute the planned divestitures.
So still some prove-it aspects there, too.
Definitely. Like IFF, DSM-Firmenich faces significant integration risk, the inherent challenge of merging two large organizations with distinct national and corporate cultures. This simultaneous execution of a large-scale integration and a major business carve-out is a monumentally complex undertaking that places significant demands on management.
Doing two huge things at once.
Exactly. A failure to deliver on those promised $350 million synergies or any significant hitches in the divestiture process would likely lead to a negative reevaluation by the market, highlighting the elevated risk profile associated with such ambitious transformations.
Okay, makes sense. Last, but certainly not least, among the big four is Symrise AG, trading as sy1.de in Germany, which we can aptly think of as the consistent compounder of the F&F sector.
Yeah, Symrise is known for its steady performance.
Symrise is a leading global F&F supplier with a remarkably well-balanced portfolio across its two core segments: Scent & Care, which covers fragrances, cosmetic ingredients, and aroma molecules, and Taste, Nutrition and Health, focusing on flavors, pet food ingredients, and probiotics.
Pet food and probiotics.
Yeah.
So they're expanding beyond traditional F&F too.
They are. They serve a truly global client base of over 6,000 customers with a vast portfolio of more than 35,000 products, demonstrating their widespread reach.
A key element of Symrise's long-term strategy and a significant competitive advantage is its aggressive focus on backward integration.
Backward integration,
Yeah.
meaning they control the raw materials.
Exactly. This means they acquire or develop control over the supply of key natural raw materials, like their well-known vanilla operations in Madagascar. This provides a crucial advantage in managing the cost and supply volatility that, as we discussed, often plagues the natural ingredients market.
So they're less exposed to those price swings.
Less exposed, yes. It enhances supply security, gives them greater control over quality, and offers better transparency and sustainability across their supply chain. In addition to this, they strategically expand into adjacent high-growth areas beyond traditional F&F, such as the pet food and probiotics markets, diversifying their revenue streams and capitalizing on related consumer trends.
Smart diversification. And their financial performance truly lives up to consistent compounder title. In fiscal year 2024, they achieved impressive sales of nearly $5.0 billion, representing robust organic growth of 8.7%.
Almost 9% organic growth. That's very strong.
Which is fantastic for a company of its size. Profitability is also a key strength, with their EBITDA margin reaching a healthy 20.7% in 2024.
Solid margins, too.
And they've demonstrated a remarkable commitment to shareholders, consistently growing their dividend for 15 consecutive years, proposing €1.20 per share for 2024.
15 years of dividend growth is impressive consistency.
It is. For 2025, while moderating their organic growth outlook slightly to 3.5% due to a more challenging macroeconomic environment, they actually increased their profitability target, now expecting an EBITDA margin of approximately 21.5%.
So slower growth maybe, but even better profits. That's confidence.
Definitely shows confidence. In response to the inflationary environment and to further enhance operational efficiency, Symrise has proactively implemented its One Sweep transformation program.
Another internal efficiency drive.
Right. This isn't just a cost-cutting exercise, it's a holistic optimization of their portfolio, supply chain, and organizational structure designed to drive profitable growth and improve efficiency. This program is already yielding results, with identified recurring cost savings of $40 million targeted for 2025.
Finding ways to be leaner.
And the company has also been active with disciplined bolt-on acquisitions to strategically strengthen its portfolio, particularly in those high-growth pet food and food ingredient spaces, demonstrating a clear and disciplined growth strategy.
Valuation-wise, Symrise typically trades at a slight discount to Givaudan, but at a notable premium to IFF and DS&Firmenich.
So kind of a silver medalist in valuation.
You could say that.
Yeah.
A trailing 12-month PE ratio in the range of 23-27x. This reflects the market's clear appreciation for its consistent operational performance, its strong and experienced management team, and a very clear strategic direction. They are truly viewed as a high-quality, reliable compounder in the sector, offering predictable growth and solid returns.
And the risks for Symrise, less dramatic than the others.
Generally less dramatic, yes. Risks include their exposure to raw material price volatility, though their backward integration strategy significantly helps mitigate this, and some exposure to discretionary consumer spending in their scent and care segment, although it's generally less pronounced than pure luxury goods. And like any company doing acquisitions, successfully integrating those bolt-ons is always a factor.
Okay, so what does this all mean for someone trying to distinguish between these giants? We've seen Givaudan as the clear premium leader, a fascinating turnaround story playing out with IFF, a newly formed powerhouse still finding its footing in DS&Firmenich, and a rock-solid, consistent performer in Symrise. But the F&F world isn't just about these four behemoths.
No, absolutely not. Beyond the big four, there are a number of mid-cap and diversified players that offer different avenues to access this industry, catering to various investment strategies or, curiosities.
Like who?
Sensient Technologies Corporation, for instance. SXT is the ticker. They're a global manufacturer of colors, flavors, and other specialty ingredients. While smaller in overall revenue than the giants, they have a particularly strong global position in food, pharmaceutical, and personal care colors, a highly specialized niche.
So they're big in color specifically.
Very strong there. Their competitive advantage lies in their specialized technology and deep customer collaboration, often providing highly customized solutions. They reported revenue of $1.46 billion in 2023, and their valuation, with a PE ratio around 35x, reflects their specialized market position and consistent profitability, though they face risks from raw material dependence and competition just like the others.
Okay, Sensient. Who else? Then there's Kerry Group, KRZL, based out of Ireland, which is a global taste and nutrition company. While they have historical dairy roots, their primary focus is increasingly on their taste and nutrition business, providing a vast range of flavor, ingredient, and functional solutions.
Kerry's a big name in food ingredients generally.
They are. Their strength comes from extensive R&D capabilities. They boast over 1,200 scientists working on innovation and deep innovation partnerships with customers. In 2024, they generated 8.0 billion in revenue with an EBITDA margin of 15.7%.
Lower margin than the pure F&F guys.
Right, reflects their broader mix. They're actually undergoing a significant portfolio transformation to become a pure-play taste and nutrition company, divesting non-core dairy assets, and their PE of around 22x reflects their strong market position, balanced by their more diversified and historically lower margin profile compared to the F&F pure plays. Risks include managing that complex portfolio transformation and some volatility from their remaining dairy exposure.
Next up is Corbion NV CRBN AS, a Dutch company specializing in bioingredient solutions and a market leader in lactic acid.
Lactic acid, like in food preservation.
Exactly. And other things. Their core competency is in fermentation technology, which they masterfully use to create sustainable solutions for food preservation, health, and even bioplastics. In 2024, Corbion generated sales of 1.29 billion.
How's their valuation?
Relatively modest, with a PE ratio around 16x, reflecting their different business mix and historical margin profile. They're a capital-intensive business, meaning they require significant investment to build and maintain their facilities. The successful scaling of their newer high-growth platforms like algae-based omega-3s is a key factor to watch and a potential source of future growth.
Okay, Corbion. And finally, in this diversified group, we have Archer Daniels Midland Company, or ADM.
ADM, the agricultural giant.
Right. Now, ADM is primarily a global agricultural giant deeply involved in crop origination, processing, and transportation. It's certainly not a pure-play F&F company. However, its nutrition segment is a significant and growing player in the ingredients space, competing directly with many of the companies we've discussed.
They've been building that nutrition part up.
They have. This segment provides a wide array of ingredients, including plant-based proteins, natural flavors, and specialty ingredients. In 2024, the nutrition segment generated revenues of $7.35 billion.
Pretty big revenue number.
But it did so with a relatively low operating profit of $386 million, indicating significantly lower margins compared to the dedicated F&F peers.
So scale, but not the same profitability. What's fascinating here is how these companies offer different ways to access the industry, either through specialized, focused niches or as part of a much larger diversified business.
Right, different flavors of investment, so to speak.
Exactly. For ADM in particular, this raises an important question about how company-specific issues, even when contained to one segment, can profoundly impact overall valuation and risk perception.
You mean the accounting investigation?
Precisely. A crucial recent development and significant risk factor for ADM is the internal and government investigation into accounting practices within its nutrition segment, specifically related to intersegment sales, essentially, how sales between different parts of ADM were recorded. This investigation led to the identification of a material weakness in internal controls and has created significant uncertainty and negative publicity for the entire company.
That sounds serious.
It is. So while their consolidated PE is around 19x, you really have to view it through some of the parts lens, considering the risks and performance of their other much larger agricultural segments, as the stock is affected by the overall company's health, not just the nutrition arm. That investigation casts a shadow.
Definitely something to watch closely there. Beyond these mid-cap players, there are also smaller specialists that offer unique exposures to particular trends within the F&F landscape. Robertet SA, for example, RBTPA, based in Grasse, France, the historic capital of perfumery.
The heartland of fragrance.
Indeed. It's a family-controlled company renowned for its leadership in natural raw materials. Their competitive advantage is truly unique. A vertically integrated seed-to-scent business model. Expert, what does a seed-to-scent business model look like in practice, and how does that give them an edge?
It's an incredible differentiator, really. Seed to scent means Robertet controls the entire value chain for some of its most critical natural ingredients, from cultivating the specific plant, to harvesting, to the intricate extraction process, all the way to blending the final fragrance or flavor compound.
So they literally grow their own ingredients.
For key materials, yes. Imagine them owning their own rose fields in Grasse, overseeing the distillation of essential oils directly from those petals, and then using those oils in their high-end perfumes. This provides them with unparalleled control over quality, ensures a stable and transparent supply, and often allows them to offer unique, traceable, and sustainable ingredients that their competitors simply can't match.
Wow.
It's the ultimate pure play on the naturals trend we discussed earlier, offering a level of authenticity and control that is highly valued in today's market.
That's a powerful competitive advantage in a market increasingly demanding transparency and natural sourcing. Robert Tett delivered an excellent performance in 2024, with sales growing a robust 12% to $807.6 million and net income rising 20% to $90.1 million.
Strong numbers for a smaller player.
Very strong. Its valuation, with a PE ratio around 20.5x, is robust for its size, clearly reflecting its unique strategic positioning and strong growth in that high-demand natural space.
What's the catch? Is there a risk?
The primary risk, however, is its smaller scale and a higher concentration in those often volatile natural raw materials compared to its larger, more diversified competitors, making it more susceptible to localized supply disruptions or crop failures.
Makes sense. More concentrated, more risk if that one thing goes wrong. And then there's Takasago International Corporation, 4914.T, a major Japanese F&F company with a truly global presence across 28 countries.
Focus more on Asia.
They have a strong strategic focus on the booming Asian market, yes, with Japan and the broader Asia-Pacific region accounting for a combined 54% of sales. This provides direct, concentrated exposure to the industry's fastest-growing geographic region, allowing them to capitalize on the rising disposable incomes and changing consumer habits we discussed earlier.
How big are they?
For fiscal year 2023, Takasago reported sales of JPY 195.9 billion, which is approximately 1.5 billion US dollars. Its valuation is among the lowest in the peer group, with a PE ratio of around 16.6x.
Quite a bit lower than the others? Why is that?
Potentially reflecting historically lower profitability margins compared to their Western peers, and perhaps the market's perception of their geographic concentration as a risk rather than just an opportunity.
Interesting. It's also worth a quick mention that while our analysis focuses primarily on publicly listed entities that provide detailed financial data, there are significant private competitors in this space that are still major players globally.
Like Maine.
Exactly. Companies like ManSA, a French family-owned company with reported sales of $1.7 billion in 2022, operate at a scale that places them as a key competitor to the public companies we've discussed. While we don't have public data for a detailed fundamental analysis, their presence underscores the competitive dynamics. It's not just the public companies.
Good point. The private players are definitely influential.
Now, let's turn our attention to the price of scent and flavor. How do we actually value these companies and rigorously assess their risks? Understanding the valuation matrix is absolutely crucial for any deeper insight.
Yeah, the numbers side of things.
When you're looking at these companies, financial analysts use a suite of metrics. These include price to earnings, or PE, which compares a company's share price to its earnings per share, giving you a sense of how much investors are willing to pay for each dollar of earnings.
The classic PE ratio.
Then there's enterprise value to earnings before interest, taxes, depreciation, and amortization, or EBITDA, which is particularly useful for comparing companies with different capital structures as it removes the impact of debt and non-cash expenses. Expert, given the huge upfront investments in R&D and manufacturing in this sector, is EBITDA a particularly telling metric? Does it help us see the true underlying operational strength, setting aside the often complex balance sheets?
That's a fantastic point. And yes, EBITDA is incredibly insightful for this industry, probably more so than PE in some cases. Because F&F companies make massive long-term investments in R&D, factories, and complex equipment, they often have significant depreciation and amortization expenses, and their debt levels can vary widely.
So EBITDA strips out that noise.
Exactly. It cuts through all that. Gives you a cleaner picture of the company's operating performance relative to its total values, enterprise value, before all those non-cash charges and financing decisions. So for an industry characterized by such heavy capital intensity and R&D spend, it often provides a more accurate apples-to-apples comparison of operational efficiency and core profitability than PE alone.
Okay, that makes sense. Like comparing engine power without worrying about the car's financing.
Good analogy. For instance, if you look at the detailed valuation comparison matrix we have, you'll see IFF's negative PE due to their recent losses, but their EBITDA, while lower than peers, still provides a basis for comparison. Or look at Givaudan's significantly higher EBITDA, which tells you the market is paying that significant premium for its strong, consistent core earnings power.
That makes perfect sense. And beyond those, we also look at price sales, price book, dividend yield, and free cash flow yield, all of which offer different lenses through which to view a company's financial health and relative value. These metrics are used to compare companies across the industry and give us a nuanced sense of their relative attractiveness.
This brings us to a peer group analysis that clearly reveals distinct tiers within the F&F industry, each with its own risk-reward profile. It's not one homogeneous group.
Right, you can sort of bucket them.
At the top, we have the premium tier, which unequivocally includes Givaudan and Symrise. Givaudan, as we've discussed, consistently boasts the highest valuation multiples, reflecting its undeniable market leadership, superior profitability, and a track record of strong, predictable execution.
The gold standard.
Pretty much. Symrise also commands a significant premium, although at a discernible discount to Givaudan. These companies are consistently rewarded by the market for their stability, high returns on capital, and perceived safety, making them core holdings for defensive growth investors.
Then there's the turnaround or value tier encompassing IFF and DSM-Firmenich. These companies currently trade at significant discounts compared to the premium tier.
Where the potential upside and risk is higher.
Exactly. IFF's negative PE and lower EBITDA clearly highlight its high debt levels and the substantial execution risk stemming from the challenging N&B integration. Similarly, DSM-Firmenich's valuation is tempered by the inherent complexity and uncertainty surrounding its recent large-scale merger.
Investing in this tier is really a bet on the potential for a significant future value creation from successful turnarounds and integrations, rather than on their current performance. It's a higher risk, potentially higher reward proposition. You need things to go right.
Makes sense. And the specialists?
In the specialist tier, we find companies like Robertet and Takasago. Robertet's valuation is quite robust for its size, reflecting its unique and highly desirable positioning as a pure play on the high-growth natural ingredients trend, particularly given its seed descent vertical integration.
The market likes that naturals story.
It does. Takasago's lower multiples, on the other hand, are likely due to its greater geographic concentration in Asia and historically lower profitability margins compared to its Western counterparts, but it offers direct exposure to that rapidly growing region.
Finally, we have the diversified or conglomerate discount group, which includes Kerry, ADM, and Corbion. These companies typically trade at lower multiples than the pure-play F&F leaders.
Why the discount?
This reflects what we call a conglomerate discount, where the market values their F&F-related businesses as part of a broader, more complex portfolio, often influenced by other, sometimes more cyclical, segments that might drag down the overall valuation. It's like buying a mixed bag. You're not just getting the pure F&F goodness, and the market often penalizes that lack of focus.
Fair enough. And as we've seen, valuation isn't the only piece of the puzzle. Risk assessment is equally critical, perhaps even more so when considering these different tiers. Our consolidated risk matrix helps us visualize the various risks each company faces.
Right, the risk matrix. What does that show us?
For raw material and supply chain risk, it's notably high for natural-focused players like Robertet, and also for diversified players like Kerry, Corbion, and ADM, given their broad agricultural exposure.
More exposure to harvests and commodity prices.
Exactly. It's medium for the established leaders like Givaudan and Symrise, who have diversified sourcing strategies or robust backward integration, which helps buffer them from shocks. This raises an important question. What stands out to you when looking at these risk profiles? It's clear that even in a defensive industry, risks can vary wildly depending on the company's specific situation and strategic choices.
It's fascinating how different companies choose to manage these risks. And the M&A and integration risk is critically high for IFF and DSM-Firmenich due to their recent large and complex mergers. You can really see that reflected.
Absolutely. It's a huge undertaking for them.
It's low for Givaudan and Symrise, who have pursued smaller, more manageable bolt-on acquisitions that are easier to digest. Competitive and margin pressure is generally medium for most players, but low for established leaders like Givaudan and Symrise, who possess strong pricing power due to their innovation and customer integration.
Their moats protect their margins better.
Right. Conversely, it can be higher for those with inherently lower margins like Corbion or ADM's nutrition segment.
Geographic and political risk are medium for most global players, simply by virtue of operating across many countries. But they become high for companies like Takasago due to its concentrated exposure to the Asia region, and for ADM given its extensive global agricultural footprint that exposes it to various geopolitical and trade tensions.
ADM's global reach is a double-edged sword there.
It can be. And finally, governance, or company-specific risk, is high for IFF and DS-Firmenich, given their ongoing transformations, requiring strong discipline management. It's particularly high for ADM due to that ongoing accounting investigation, which impacts investor trust and internal controls.
That really stands out for ADM.
It does. In contrast, it's low for the more stable and consistently managed players like Givaudan and Symrise.
This comprehensive risk view is absolutely essential for anyone looking to invest or simply understand the nuances of these companies beyond just their growth numbers. It really underscores that even in a seemingly stable industry, there's a spectrum of risk and reward depending on which horse you back.
Couldn't agree more. It's not monolithic.
Okay, let's tie all this together with some thematic investment considerations. How might someone approach this industry based on their goals?
Right. Different angles for different folks.
If you're a learner looking for core defensive growth exposure, meaning stable, long-term exposure to a defensive growth industry with high barriers to entry, then Givaudan and Symrise represent the highest quality options available.
The sleep well at night stocks, maybe.
Perhaps. They offer proven business models, consistent operational execution, strong balance sheets, and very clear strategic directions. The primary trade-off, however, is valuation, as the market already awards these companies with premium multiples, meaning you pay a higher price for that quality and predictability. You're not getting them cheap.
Fair enough. What about value hunters? For those seeking value and turnaround potential, the transformative mergers undertaken by IFF and DS-Firmenich have created a distinct value-oriented theme. Both companies currently trade at a significant discount to their high-quality peers, precisely reflecting the substantial execution risks of their complex integrations and portfolio transformations.
So the potential for a big payoff if things go right.
Exactly. An investment in these companies is truly a bet on management's ability to successfully navigate these challenges, deleverage their balance sheets, and ultimately unlock the latent value and synergy potential that these mergers were designed to achieve. The potential upside is considerable if they succeed, but so too are the risks of continued underperformance if the execution stumbles. High risk, potentially high reward.
If you're looking for pure play exposure to secular trends, meaning a more targeted bet on the powerful consumer shift towards natural ingredients, Robertet stands out as a unique option.
The seed to scent play.
Right. Its vertically integrated seed-to-scent model offers the most direct exposure to this high-growth theme, giving you a focused play on the premium naturals market. Similarly, for concentrated exposure to the high-growth Asian consumer market, Takasago offers a direct vehicle, allowing investors to capitalize directly on the rising consumer class in that region.
Although it does come with associated geographic and currency risks that need to be considered carefully.
Good point. And finally, for broader food ingredient exposure, companies like Kerry Group, Corbion, and ADM's nutrition segment offer exposure to the F&F industry within a broader food and agricultural ingredients context.
If you want F&F, but also other stuff mixed in.
Exactly. These companies may appeal to investors seeking a more diversified business model that touches various aspects of the food supply chain, though they typically come with lower overall margin profiles and exposure to different sets of risks compared to the pure-play F&F leaders.
And that ADM caveat again.
Absolutely. It's important to reiterate that the company's specific issues at ADM, in particular related to that accounting investigation, require very careful consideration and due diligence from any potential investor.
That's a truly comprehensive look at the market. And as we start to synthesize all this information, host, it becomes clear that there's truly something for every kind of investor or curious mind in this industry. It's not just about what smells good or tastes good, but how those preferences shape massive global businesses, creating entirely different types of investment opportunities.
Totally agree. So as we wrap up this deep dive into the fascinating world of flavors and fragrances, we've explored everything from how your shampoo gets its signature scent to the multi-billion-dollar giants behind your favorite food's taste.
From the everyday to the complex financials.
We've seen an industry that is both incredibly defensive in its demand and remarkably dynamic in its innovation, constantly adapting to meet evolving consumer demands while battling significant operational complexities. Next time you pick up a packaged food, a personal care item, or even a cleaning product, take a moment to consider the invisible journey of its flavors and fragrances.
Think about the science behind the sensation.
Think about the intricate science, the global supply chain, the spanning continents, and the immense research and development that goes into creating those sensory experiences you often take for granted. What new taste or scent innovation do you think will truly reshape our world in the next decade?
Hmm. Good question to ponder. AI-driven personalized sense, maybe.
Yeah, could be. Thanks for joining us for another deep dive. We hope this has given you a fresh perspective on an industry that's truly essential to our modern lives, often hiding in plain sight.